Hi everyone, I'm Caroline Zakari and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Literacy Month. Today's presentation is called Retirement Planning and Financial Independence and is brought to you by the Financial Planning Association of Los Angeles and the Los Angeles Public Library. Today, Jamie Rugg from the FPA will be exploring the universal reality of retirement, as well as many savings and retirement options individuals can rely on when planning for the future. She will also offer information relevant to each stage in a working adult's professional life, from the 20-somethings to the final years before retirement. We will have a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you, and take it away, Jamie.
All right. Good afternoon, everyone. Thank you so much for joining us today. Very excited to be with you as we go through our retirement planning presentation. And during today's session, what we really want to focus on are where are the areas that we have control over our retirement and retirement preparedness? What can we do today or in the future to make sure we're setting ourselves up for success as much as possible? As a reminder, we will be going through the presentation today. I have quite a few slides, so I'm going to try to get through all of them and just try to pack as much information as possible to deliver as much value to you for your taking your time out of your day today to join us. We won't be able to go through direct investment advice, but we will go through various steps on what we can do, how we can prepare, going over what does retirement look like today, the two real key phases, saving when you're accumulating to get ready for retirement, as well as spending. How do we start to approach, what do I really need to have in retirement? What does that cost look like on an annual basis and the longer term? The various types of retirement accounts, how you can think of coming up with other sources of income in retirement, considerations to make your investments last as long as possible. And then we'll recap at the end with steps, like the most efficient steps to do today or whatever phase you're in to prepare you as much as possible for your future. So first and foremost, and one thing that we always want to kind of touch on, retirement really truly is a time of change. And not just, I'm no longer working. Certainly that is going to be a shift. But really we want to focus on what is your definition of retirement. Retirement can look extremely differently to different people, depending on your preferences, priorities, health, and a number of different considerations throughout the way. So what's going to be different? For you, when you think about looking whether you are a couple years out, you're already in retirement, or you're thinking 10, 20, 30 years down the line, visualize what you feel your retirement is going to look like, both personally as well as financially. How do you want to allocate that extra time you have if you're no longer working or you're only working part-time? So there are those two primary phases that we mentioned. The saving, or what we call in the financial planning profession, the accumulation phase, as well as the spending phase, when you're starting to draw down from your various investment accounts or retirement savings accounts, and actually starting to spend and enjoy after all the hard work you've put in over those years. But as we continue through the workshop and the presentation today, I do want you to keep in mind, if you're taking notes or you're just thinking on this presentation, what do I want my retirement to look like? What areas do I have that I can control? And what can I do to help myself set myself up for success? And a lot of that too oftentimes comes down to, how am I going to meaningfully fill my time? Whether that's volunteering, getting involved in other types of associations, whether it's being more tied into your community, exercise, travel, spending more time with friends and loved ones. Really want you to visualize what that's going to look like, what you want it to look like, because there's no perfect answer for how much money you need or how you want to spend your retirement. We really want it to revolve around what matters to you most. So when you talk about the retirement equation, as you see on the slide here, there are actually, even though we feel like, okay, I can do a lot of this, there are really only a few areas that we can completely control or that we have an influence over. So just to take a look at the chart here, we really want to focus our time and energy on the areas that are under our control. So what can we control? We can directly control how much we're saving, to some extent how much we're spending. Those are areas that we can control, as well as asset allocation, or in this situation, that means how we have our investments actually invested. How much is going to bonds, how much is going to stocks. Those are areas that we can actually control directly. We have some control over how long we end up working, as long as we're healthy and we're able to continue working, and as well as our longevity. So we do have influences over our health and our general wellness, but of course not complete by any means. But in terms of what we can't control what's going to happen in DC or in Sacramento with taxes and legislative decisions. And we also can't control exactly what the market's going to do for those market returns. So we really want to spend that time focusing on the areas that we can influence. Health, certainly, doing things we can for ourselves for the long run, but really most importantly, of course, the saving, spending, and how we're actually allocating, how we're investing our money to be prepared for the future. One thing we certainly want to emphasize, and I feel like everyone listening probably is aware of this, but most of us are not going to experience our parents' version of retirement. There is much more of a dependence on your personal savings and investments. There are not as many pensions. While that used to be the most common way that people had income in retirement in decades past, they're less and less common. If you do have a pension through work, that's fantastic. Those are actually very, very valuable. Social Security, you've probably heard in the news, Social Security has not quite enough funding, once we get into the 2030s and so on, 2033, 2034. That is actually fixable, and there will be a way that'll end up being fixed. But because of that uncertainty, it does provide a little bit of a question of what that's going to look like for those of us that are farther out from retirement. Anyone who's very close to or already in retirement, already claiming their Social Security benefit, is very likely to continue to maintain this similar level because our citizens are it's so important, it's so crucial, it's such a huge part of their day-to-day living expenses and income that really can't be changed for most residents and individuals in the US. A lot of us are going to be working longer, and with increases in longevity and health, a lot of times people now are feeling more comfortable to have a part-time job, whether it's because they need to or they want to. And then of course we do have a longer life expectancy substantially. So if we take a look at the chart on the right here, this is as of 2021 or so. But if you were age 65 in 2021 as a female, your expected longevity or life expectancy is actually 84 and a half years old, and so on and so forth in that table. So once we've actually reached that age where we're getting at retirement, your life expectancy is significantly higher than when we look at those standard charts for, estimated 76 or 77 years old. So we really do, when we think about retirement, we want to genuinely plan for 30 years out, at least 20 to 30 years out, especially if someone is in good health, whether that's you or you're thinking about retirement planning for a parent. Okay, so a couple quick things, and it's hard to test the knowledge here in a virtual way, but I just want you to think through these questions and decide whether you think they'd be true or false. So, true or false, Medicare is free for retirees, and you're welcome to add any comments into the chat or not. And also, as we go through, as Caroline is mentioning, if you do have questions you want answered, whether during the session or at the very end, please feel welcome to type in your questions. We do want to make sure we deliver as much value as possible for you today. So back to the questions. True or false, Medicare is free for retirees. This one is actually partially true. Medicare Part A is free for retirees. There are other parts, whether you have B and D, or you have an Advantage plan, there is some portion that is actually paid, whether it's through Social Security or you're paying it directly, but generally through Social Security. Does Medicare cover long-term care costs? True or false? This one is actually false. Even though it feels like Medicare might cover the cost of being in a long-term care facility, it actually does not. That's one of those planning areas that we really want to pay attention to as we're approaching retirement and considering whether or not we would want to invest in purchasing a long-term care policy. Just one quick caveat here. If you are considering long-term care for yourself or a loved one, you really want to go through that process around by the time you reach age 55, give or take. After that, the premiums start to increase quite substantially. So around age 55, that's when you really want to start to consider if that makes a sense for you to purchase a policy. Things to consider there: if you have family members who have needed to be in a long-term care facility for years on end, any kind of genetic history where there are kind of more long-term illnesses that require additional care, And that includes memory care, dementia, Alzheimer's, anything like that. You do want to run through that exercise to see if it makes sense for you. Okay, so your regular 401k account is worth $100,000 in this example. So you have $100,000 to spend. Do you believe that that is true or false? $100,000 in your 401k, does that mean you have $100,000 to spend? This one is actually false. Hopefully anyone listening would think that as well. When you have money in a regular or traditional 401k account, and we will cover this later on in the session, that money has actually not been taxed yet by the federal government and the state of California. So you actually want to think of that as almost $75,000 or $70,000 rather than $100,000. The government lets you get a tax benefit. Basically, you deferred taxes so your money could grow more over time. But as a result, you actually still owe that money. There is money that has to be paid back to the government as you take the funds out. And we'll cover that a bit more as we continue on today. Even if you are covered by 401k or a 403b plan at work, you can still contribute to your own traditional IRA account. IRA meaning individual retirement account. Is this true or false? This one is true. Everybody that is earning in any sort of qualified income that the IRS will consider income is eligible to contribute to a traditional IRA account. Even if you have a retirement plan at work or you don't, everyone has access to those. It's another tax deferred way or kind of a tax benefit for us to be saving money for our future. So that is allowed for every resident, every person in the US. All right, a couple more questions here then before we move on to the next section. If you were married for 10 years, got divorced, together 10 years, got divorced, and you have not remarried, you can claim Social Security benefits based on your ex-spouse. True or false? You're married, got divorced, you've not been remarried. Can you claim Social Security benefits based on your ex-spouse if you were married for 10 years? This one is true, and it's not as well known of a fact, but if you were married at least 10 years and then you did get a divorce, you are able to claim that benefit based on the earning amount of your ex-spouse. So if you were previously married, your ex-spouse was a higher earner than you, and you have not since remarried, you would be able to claim that higher benefit amount based on the years that you were married. So one thing to consider if you or yourself or a loved one has gone through a divorce. Our next one, to left, you may be taxed on up to 50% or up to 85% of your Social Security benefit. True or false? This one is also true. One area I think we don't think about, we don't learn much about during our working years, but Social Security benefits are taxable up to 85%. It's between 50 and 85. Even though you are earning that income and it's money that we set aside in the Social Security system, unfortunately, it is actually true. You still get taxed on that. That's why so many people in retirement don't actually realize they're often in their highest tax paying years when they're actually retired, even though you think, I'm not earning income. Why would I be taxed so much? A lot of these different areas, there are still some taxes that do come due. So another thing to think about, even your Social Security benefit amount, sometimes a chunk of it is taken out for Medicare, depending on which parts you have. And then another portion is taken out for taxes as well. And if you don't enroll in Medicare, in parts of Medicare within certain time windows, you could face lifelong premium penalties. This one is also true. They have been making changes to it with some of the legislation that was passed last year to kind of try to reduce some of the longevity of some of these penalties. But it is true, if you don't sign up in time, you can face lifelong premium penalties, meaning it is more expensive for your entire rest of your life. That's why you get inundated with all those mailings when you're approaching 65, when you're fully eligible for Medicare. Please pay attention to those, or for yourself or a loved one, just to keep an eye on that. You want to make sure you're enrolling when needed. Okay, on to the next. So we talk about those two phases of retirement also. In addition to the saving phase and then the withdrawal phase that we mentioned at the start, there kind of really are two main phases of retirement itself. So traditionally, we think of our lifestyle. What's life going to be like? What am I going to do with my time? all of that. But, want to be careful with cash flow, with our expenses. We want to hopefully still maintain that nest egg. And it's still important to keep investing, even though it feels like, okay, I've reached this goal. I am retired now. Now we have to plan for 20 or 30 years worth of potential expenses. So it's really important still to stay engaged with how you're investing and what's going on with your accounts. So that's more the traditional concept. We think about how we're going to spend our time, maintain our lifestyle, our cash flow. But also a second phase is legacy. What do I want life to look like? What kind of lifestyle changes might be coming, whether it's health related or other areas, downsizing in a house or moving into some sort of care facility, potentially assisted, but also long-term care, and then estate planning. If I do have a leftover nest egg, who do I want that to go to and how do I want them to receive it? So all of those things of carrying on a legacy, or do I want to leave items to charity? There's quite a bit. So there are two main phases. The earlier phase, which is really focusing on how you're going to spend your time maintaining for the longer haul, then also thinking about what legacy do I want to leave? How do I want my life what do I want it to look like, and how do I want it to feel as I get into the later stages of my retirement? So one key area, of course, and I will tell you it doesn't matter if someone is making $20,000 a year or $2 million a year. It doesn't matter. The most important thing that that we come across as a financial planner is your spending. It's how much do you have left over at the end of each month versus your income versus your expenses. It doesn't matter your income level. This is universal for everybody. I do apologize. Some of this got a little bit squished in the presentation here. So first and foremost, we want you to think about spending. Where is my spending going to come from? Where is my income going to come from to offset the cost of my lifestyle? So the basic, or what we call essential spending, of course, the bottom of the pyramid here, housing, food, utilities, prescriptions, insurance, loan payments, whether it's for car or loans, credit cards, housing, or mortgage. I mean, this is where we usually see people kind of match dollar for dollar. Okay, if I'm covered, I have this much in my monthly expenses. I know my rent or my mortgage costs X. I know I spend about this much on food, and so on and so forth. Oftentimes, that's how people kind of match that to the dollars they're receiving from Social Security, as well as pensions, or if they do have an annuity that they have purchased, or from income from bonds or CDs or something of that sort. Extra or discretionary spending is the next step up. What do I like to do that I would enjoy to do, but it's not absolutely essential to me maintaining my lifestyle? That would be more travel, gifts to potential family members, concerts, other types of activities that you really enjoy. Those are the nice to haves, but they are not essential to you getting by on a day-to-day basis. In those types of priorities, that's where cash equivalents, dividend paying stocks can be appropriate. But when we think about something like the very top of the pyramid there, where it says legacy, we talk about what do I want to leave over? So if I have all of my basic needs and all of the things I'd like to have ready and covered, now what do I do with this extra amount at the top of the pyramid? And that's where people start to consider things like leaving an inheritance to family members, giving money to charity. In that situation, when something is more growth focused, that's where it's more appropriate for some of that money, that chunk of money, if you even think of it from like a bucket approach, that can be more invested towards growth-oriented portfolios, alternatives, or private investments, things of that nature. All right, on to the next one here. So when we talk about this, because really what I want everyone to have today from listening and spending your time with us is to have a couple key takeaways, key points that you can apply and think about your situation and hopefully set yourself up for more retirement preparedness or success. So one area we want to think about is estimating your retirement costs. It's one of those areas where I really don't know exactly how much I'm going to need on an annual basis. Like, where do I even start to figure out that number? In general, it's safe for most people to default to 75, 80%, or up to 100% of your current income, your pre-retirement income. So what you're taking in on an annual basis right now, or if you're close to retirement. Back of the napkin math, I account for at least 75% or 80% of that. If you know that you have a lot left over each month that you're not getting anywhere near to what what you're earning, that's fantastic. You can lower that. So just look about your actual monthly cash flow, or on an annual basis, how much money you received, since it is tax time right now, versus how much money you spent. And think about that, because that's actually what you'd want for each year you plan to be in retirement. That number can seem quite scary. However, we have to remember that this money is going to be invested over time too. It's going to be, ideally, a lot of this is going to be invested in the markets. So it is keeping up to your question with inflation, and as well as some of these other areas. So expenses can be less if your mortgage is paid off. That's oftentimes the largest expense in retirement, is still housing. If you don't have job-related costs, and if your children are grown and no longer in the house, that can certainly help expenses being less. Or if someone were to downsize into a smaller footprint home or residence for their housing, and the expenses could be higher if there are, increased healthcare costs, which is the largest and fastest growing segment usually of expenses in retirement. Home maintenance, utilities, and taxes, certainly those can increase. We don't necessarily directly control that. Also, if you do want to use your retirement time to really focus on hobbies and travel, the things you really enjoy, everything you've been working and saving for to get to this point, also think about that. So when you think about the 75 to 100% estimate, just know that, think about, for your situation, what you anticipate or what you're in right now, how much expenses, if they're going lower or going higher, if you need to estimate a little extra or a little bit less. All right, so when we also look at the actual retirement cost, just a couple quick examples here. So consider your current income, just to kind of put some numbers to paper. When you do retire, do you expect to spend less each year in retirement, or about the same as now? And it is a really helpful exercise, even though going through a budget or cash flow is not the most fun. There are a lot of various apps out there that help you do this, but think about what you're currently earning today. So we put in an example here. It's assuming someone's making $65,000 per year right now, they're really close to retirement. So if they needed 75% of that income each year, 75% times 65,000, they would need about $48,000, just under $49,000 for that first year in retirement. And this is, again, really quick back of the napkin math. If they think they need a little bit closer, like actually I need a little bit more than that, 90% of my current income, that would be around $58,500 for someone that's making $65,000 a year. And again, we think about 20 to potentially 30 plus years in retirement, the numbers can start to seem pretty high, but we'll go through ways to set yourself up so you can see if you're on track, but also think about what could be coming next. So there certainly are a couple risks as well that we don't always anticipate when we think about retirement. What if work ends unexpectedly, whether a company is sold, or I have a health issue, or there's a layoff? So there is a forced retirement risk, and there's an actual studies continue to show regarding retirement confidence surveys, 43% of people end up retiring earlier than planned. We oftentimes will hear, I plan to work until I can't work anymore. I'm going to plan to work to 72 or 75. I'll make up for what I haven't been able to set aside just by working longer. The challenge with that, of course, is, again, 43% of people retire earlier than they anticipated or potentially wanted to. Sometimes it's because they're able, but oftentimes 35% is due to health or disability, 35% to downsizing or closures in their company, or and then 13% to actually help take care of another loved one. The I just work till I die is a common thing we often hear, but what if you can't? And that's what we want to think about, at least, so we're prepared for what that could look like. And working a little bit longer, I will tell you this right now, has a much bigger impact than if you were to actually save more at the very end of your working years. So protecting income, we mentioned long-term disability income insurance here, is wise if you can afford it. It is quite pricey in terms of, it's like pretty much like the most kind of expensive type of insurance for disability insurance, because it is protecting your working years, your human capital, what you're expected to still earn over your lifetimes. If you have a group policy through work, a group disability policy is worth at least considering. But again, that is up to everyone's personal situation of what is appropriate and what is not, and what that policy looks like. So we'd ask you to check in with a financial professional in those situations. So that is what would happen if you're forced to retire earlier. But some people that, even if you choose, I'm going to work a little bit longer or work a little bit less, each year you work an extra year in retirement, or what you would consider retirement, is actually taking off a full year of what you'd have to cover in costs, right? That $48,000 or so dollars in our example in a couple slides ago. But also, I have a lot of clients or people I speak with that also say, you know what, I'm done. I want to be done at 62, or I want to be done sooner. I'm ready, which understandable, absolutely. One thing to think about: every year you retire earlier than you anticipated or earlier than you had planned for. It's not 1 year in retirement of extra costs. It's actually 2, because you cut out a year on the leading up to retirement, and then you also have an additional year you didn't anticipate for of where you need your savings, what you need your savings to cover. So when you do retire earlier, you're forced to retire earlier. It's actually a double whammy versus being able to stay until you plan to retire. So we talk about, how do we build retirement savings? There are tons of different types of accounts. What do they mean? What do they look like? We are going to go through these in a little bit more detail in the upcoming slides. But in terms of building retirement savings, first and foremost, most common we hear about, the individual retirement accounts, IRAs, and that everyone's likely familiar with, or the employer-sponsored plans, your 401ks, 403bs, 457 plans, all the various options that you get through work. There are also simplified employee pension plans, SEPs, or used to be called KEO plans. And then some people also use purchasing annuities, whether they're fixed annuities or they're variable, meaning they're kind of invested in the markets, to actually have a set amount or a variable amount of income each year in retirement as well. And then also just in taxable investment portfolios, if you open up a brokerage account or you open up any sort of individual account just through a bank custodian and invest the money yourself, those are generally taxable investment accounts. So those are the primary ways that people are building those retirement savings accounts to prepare for the long term. All right, so I have a couple checkpoints here that we're going to go through that I added in because I think it's helpful. Sometimes it's like, I know I should be saving as much as possible. What does that actually look like? Where should I be right now? So we have 2 of these retirement savings checkpoints that we'll go through just a moment. So what I want you to do, if you're listening in or watching with us right now, take a look at where your current income and your closest age actually intersect. And there is another chart on the next page for incomes from 100,000 and above. But this first checkpoint is for anyone household income. So not just yourself, but a household. If you have a spouse or partner and you're combining income. So find where your age and income intersect. And actually you multiply by the income amount by that factor. So in this example, so if I am 40 years old and I'm making $50,000 a year, 40 times for that, where those intersect is a factor of 1.4, and that 1.4 is $70,000. So in that example, it suggests at this point that I already have at 40 and earning that amount of $70,000 in retirement savings. I'm going to give everyone a couple more seconds here to take a look on this table. Then we're going to move on to the next one that has another set of income levels. There are certainly a couple assumptions here: 2.5% inflation, how you're invested, 60% stocks, 40% bonds, and so on. There are a number of different assumptions we're using, but this is just a kind of a quick just touch point of approximately where should I be. And if you are not on track yet, that's okay. This is just here's, if I wanted to maintain the same or similar lifestyle in retirement, what would this look like given today, along with a number of assumptions and assuming, living 30 years into retirement. So here's the next one. I'm going to leave this up for a few more seconds for household income from $100,000 to $300,000. Same thing. Find where your closest income level and age intersect. So if it was $200,000 and age 50, that factor would be 6.6. So I'd multiply 6.6 times 200,000, and that's what it would be suggesting I should have set aside already, given that level of income. So some of the assumptions here too are that we are going to be spending quite a bit we're probably spending most of this income that we're making. A lot of people are actually very good about not spending nearly what they're earning. Most people spend pretty close to it. And as they make more money, they usually end up spending more money also. So just another, if your situation looks very different from that in terms of what you need on an annual basis, that's great. But so let's say we're starting as you're like, you know what? I haven't had the opportunity. It hasn't been doable for me to do that. I've had a lot of competing expenses. What do I need to do now if I need to start saving? So same thing, we go through these two charts. I'll go a little bit more quickly on this one. If I am starting at 0 today, what percentage of my income do I need to be saving? So same thing, I'll find where if let's say I'm 40 years old again and I'm making 50,000 right now, if I'm starting with 0 in my retirement savings, the suggested amount would be 13%. So going forward, I'm saving 13% of my gross income into annual savings, retirement savings for my future. And we want to think about this too. Take care of yourself first. If you have a tax refund that comes in, or you have something else, you look at your monthly cash flow, think of paying yourself first for the future. You're taking care of you, and then you're covering all those other expenses, as well as the nice to haves that you want to enjoy today. And then here's the last chart for the other income levels. So same thing, I'll leave this up for a few more seconds. One thing to note, of course, the higher the income and the later we start, the higher the amount we have to save in order to, theoretically maintain that same lifestyle in retirement. That is why it is so crucial and so valuable if you can start as soon as possible. And if you're starting today, it's all doable. It's just you have to be mindful of. There could be areas where you might need to cut back or be really careful with your expenses if you don't have any of the savings set up today. So, all right, I am going to move on to the next. Hopefully everyone had a chance to take a screenshot or take a look at this, and this recording will be available after as well. So what to cover if you want to modify your approach over time? If you're at different timeframes, I apologize, the colors here are a little different in this version on here. So if you're in your 30s, take a look at which age bracket you fit into. I won't go through every single one here, but as you're getting closer to retirement, you do want to shift up some of the activities you're doing. When you're in your 30s, it's appropriate to be more aggressive with how you're investing, meaning more growth, more stock-oriented type of investments. Still you want to save it and invest at least 10% of your income, ideally a little bit higher. You think about a long-term savings plans. Make sure you start to develop an estate plan, especially if you have family or loved ones or children. In the 40s, try to up that to at least 15% of your income if you can. There are competing goals, and certainly we're mindful of potentially raising children and also taking care of aging parents. Be sure to maximize your company benefits. In 50s, try to get that number up to at least 20%. If you were to receive any sort of inheritance or something from a family member, really make sure you're investing that back in the market so it can appreciate over time and hopefully outpace inflation. Because inflation does eat away, as we've all seen, the cost of goods. It does eat away at our purchasing power and how much our money is actually worth, the actual value we have. And also in your 50s, that's where we consider long-term care insurance. In your 60s, start to think about income-producing investments. What other investments can you have that will help offset those costs in retirement? So it's not just I have to pull money out. It's actually going to produce income, just like Social Security, so that you can set money aside. Start thinking about when you're going to claim Social Security. There's a whole bunch of kind of strategies of when you want to claim. The earliest you can claim is 62. Latest you can claim is when you hit 70. The longer you wait past your full retirement age, the more money you're going to receive, and it's substantial. It's like 8% additional a year. You're getting 8% return basically once you hit your full retirement age if you delay taking your Social Security benefits. So highly recommend it if you're able to do that. But this is something you want to plan for in advance so that you can maximize that. But if you are withdrawing a lot of money from your savings and your retirement accounts, though, in order to delay Social Security, that's not necessarily worth it. So you want to think that through and look at what the SSA is sending you when you're thinking about that. And then in retirement, first and foremost, monitor those expenses. Ideally, keep your withdrawal rate under 4%. We'll talk about that a little bit more. Keep an eye on that investment allocation. Make sure it's appropriate. Make sure you have an estate plan, even if it's just a will and trust and something updated so your loved ones know what your wishes are. And again, stay active, enjoy, and take care of yourself. So, okay, accounts and ways to hold money. So we're going to talk a little bit about the various types of accounts. So Tax Now, these are more of the taxable accounts. Whether it's I bought some Tesla stock and whether it went up or down, that's if it went up, I sell it, I have to pay taxes to the government and the IRS. Bonds, you directly buy mutual funds, any savings account you have, your checking or savings, the bank, if you had any of that invested, bank deposits, any of that when you're buying and selling different types of securities or stocks or bonds, If there's a gain in that, you pay taxes on that money now when you're filing taxes right around this time of year. Anything taxed later, or what we call tax deferred, those are your 401k plans, those pension plans, those traditional IRA accounts, potentially annuities, part of the annuity as well. That is usually oftentimes a qualified plan. Qualified meaning the government is giving you some sort of tax deferred benefit so that you can save for retirement. So that's why we hear qualified retirement plans. And then tax never. There are certain types of accounts and assets that are never taxed. Tax never. Roth accounts. So if you've heard of Roth IRA, those actually are taxed. The money is taxed on the way in. We'll talk about this in a few more slides. So that when you are using the funds in retirement, you do not have to pay taxes. So a Roth account, if it had $100,000 in it, is actually worth $100,000, a Roth IRA. Municipal bonds don't get taxed, whether it's federal or California, depending on which one. The cash value of a life insurance policy also is not taxable. Tax-exempt mutual funds, there are some of those. 529 plans, when those funds are used for qualified education expenses for yourself, for a child, for a loved one. If you have a 529 college, basically college savings plan that are using for tuition, books, anything like that, that's a qualified education expense. That is also never taxed. And then healthcare, the health savings account, HSAs that you may have available through work. When those funds are used for qualified medical expenses, they do not get taxed. The funds, even the growth in the account, does not get taxed, and the money doesn't get taxed on the way in. So I'm going to quickly go through taxable investments again, just a little bit more of a deep dive in some of these areas as we continue on here. Taxable investments, so brokerage accounts and individual taxable investment accounts. You can choose any investment you want. You're the one responsible usually for this, unless you hire an advisor or financial planner has a limited power of attorney to invest this for you. You can diversify your portfolio. There are no contribution limits. There are no withdrawal rules. It's your money free and clear. You just pay taxes on it if you have gains in the account in the specific positions. There can be additional income options, whether it's a specific type of security you're purchasing or it's a bond that's throwing off cash flow. And then if you do hold on to a particular investment, let's say Tesla investment. Tesla's been down a lot this year. Let's say you hold on to it, it goes up, and you hold on to that for a full year. When you pull the money out of there or you sell that investment, if you held it over 1 year, it's a long-term capital gain. It actually is different tax at a much lower tax rate than it would be in the same year that you purchased it. So going back to those tax deferred plans, those qualified retirement accounts, 401k, 403b, 457, et cetera, all the earnings or the growth in those accounts, it's tax deferred, meaning, you know what, I got to put this money in there. Now it gets to grow each year, even if it's growing a lot, and it's growing a lot. It's up 10% last year. It's doing this, it's doing that. You don't actually pay money on that, taxes on that on a given year until you take the money out. Then you pay taxes on whatever the portion of the amount you're taking out. Some contributions were also, you didn't pay taxes on the way in. If you when you're filing your taxes, if you said, oh, I made $5,000 contribution towards my 401k this year, oftentimes you can get, they're not, the government's basically saying, okay, we're not even looking at that money for tax purposes. So it's went straight into the account. But as a result, that money has never been taxed. So you're going to get taxed for it on the way out. The government is going to get their fair share at some point, one way or the other. Death and taxes, it's a real thing, the two certainties. Contribution limits can vary by the type of plan. It can also vary by income level, and there are a number of other qualifications. They do want it to be as fair as possible, so there are various rules you have to follow. And then there are withdrawal rules as well. So if you can be penalized for withdrawals and have a penalty if money is taken out before you reach 59.5. Also, a percentage of the account is required to be taken out for RMDs after you reach age 73, starting in 2024. That was part of the Secure Act as well. So even if you have you build up a large balance in your 401k, your 403b, or your IRA, once you hit that age in retirement, you have to take out a percentage that's based on these IRS tables each year, because they don't actually want there to be massive accounts that are going to the next generations. The whole point of these accounts was to save for your own retirement. And then the final one on the tax-free plans. So we mentioned Roth IRAs. There are also Roth 401ks and Roth 403bs that are offered through work. There are more and more of these options now. Your company might have a Roth 401k option, so definitely consider it. It's, again, similar to traditional retirement plan, but you are actually putting after-tax money in. So you've already paid payroll taxes or taxes on that money. Then you put it into the account. It gets to grow, continue to grow, tax-free over time. And then if you follow the rules, you're over 59 and a half, and the account's been open at least 5 years, you're able to withdraw that money tax-free in retirement. And you're no longer required to make those RMDs, those withdrawals from Roth accounts. You wouldn't have to pay taxes on anyways, but you can actually leave the funds in there. This is the best and most efficient way to transfer any sort of inheritance to a loved one if you had some of these accounts left over. So another thing to think about. But so this is after-tax income. They're very valuable. Oftentimes people ask, which one should I do? Should I do a Roth or should I do a traditional account? Like, how do I decide which one is more valuable? Which one is the one I should consider? You want to think about your tax rate now versus what you think your tax rate might be when you're actually retired. It's hard to guess what that's going to be, but that's really the difference. If you're paying more in taxes now than you think you will in retirement, it usually makes more sense to do a traditional 401k or IRA. If you think you are going to be, because of Social Security, or maybe you have real estate income or you have other income and you have a pension and you might have annuity and all these other various forms of income in retirement, if you actually, just like a lot of people that are in the highest tax bracket of their life when they're retired and no longer working, if that might be the situation, it makes more sense to do a Roth oftentimes. I will tell you the number one complaint of all of my clients is that they wish they had just paid the taxes now and set up money in a Roth. That's the number one regret I hear from so many of my clients who are retired. All right, making the most of your employer's retirement plan. Most importantly, participate. Make sure you are enrolled. If you have a retirement plan or you have an option, please, 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 please make sure. Contribute as much as you can. Ensure you're at least, if there's a company match, absolutely make sure you're contributing enough to at least meet the minimum for the match, because that is free money for you. Employer retirement plans have a lot of already semi-pre-vetted plan choices and options. You can choose how you want that to be invested, but make sure you're diversifying, not putting everything into one stock. Make sure it's kind of invested in something that's going to grow over time, or one specific fund that is geared towards retirement, like a target date fund. Target date fund, 2060 would be for someone that thinks they might retire around 2060. Reallocate annually. At least look at your statements once a year. Think about what the costs are, the expenses on the funds you're using, and just keep an eye on what it's doing. And if you do change jobs, consider whether or not you want to roll those funds over to an IRA or to your new company's retirement plan, as long as the expenses aren't too high and you think it's a well-managed plan. So a couple quick things to avoid for retirement mistakes. Failing to participate is the main one. You'd be surprised how many people are not actually enrolled in their 401k plan. If this is yourself or a loved one, please, please, please encourage them, their HR department or someone that can help them get that set up relatively easily. Another thing, not being the match, again, that is free money. If you have to set aside 5% of your income in order to get 3% of additional money for free, that is free money you're missing out on. That's going to massively help you reach some of those retirement savings goals. Another one, borrowing from the plan, is even though we have that pot of money and sometimes times are hard, it is so detrimental to what that growth is going to be over time if you actually do take money out of the plan. As much as possible, please, please, please don't borrow from the plan. You are stealing from your future when you do that. Also, cashing out early, taking money out of that account, leave it in there. Even in retirement, you still need that account balance to continue to grow and appreciate over time to help you get through those 20 to 30 potential years in retirement. And again, not checking on the fees and on your investments, at least on an annual basis, to keep an eye on it. Even though it's kind of a set it and forget it, it's out there. We know it's doing its thing for us. Make sure you're checking in to ensure it's on track, at least annually. All right, and a little bit more on those traditional versus those Roth retirement accounts. So a lot of different things here in this chart, but first and foremost, like we talked about, contributions. If it's into a traditional 401k or IRA, that money has not been taxed yet. You get to put it in there. It gets to grow, tax deferred, so it's not getting taxed each year. And then you don't actually get taxed until the very first time, until you're starting to take the money out in retirement, and then it gets taxed at whatever your prevailing income tax rate is that year in retirement. So if you also happen to sell a house that year, or you had another large income event or something else, that actually can pop you up into a higher tax bracket, which is why you want to think about what your tax rate might be down the line. Whereas with the Roth, you're saying, okay, I already paid taxes on this money. It's already been taxed. I'm going to put it into this account. It's going to grow for me for free each year if I follow the rules. And as long as I use it, I wait until 59 and a half and the account's been open for 5 years. I follow these rules. None of that money is taxed after. So you get to these Roth accounts over time outpace a traditional, if they're invested the same way, outpace a traditional 401k or 403b when you get into those 20, 30 years down the line. They can end up being more money because it's now gets to compound, and that huge chunk is not taken out in taxes. So if you have the ability to open a Roth account, and there are some income limitations too, if you have extra cash left over, that is the most valuable thing you can put your money into. Even if I hope one day you're like that one girl mentioned this one time about this Roth IRA account, and I'm glad I listened. Just open one if you can. They're free to open at pretty much any custodian. And you'll be very happy that you contributed to it over time if you end up doing so. So if that's my one tip and takeaway from today, please do it. All right, so how do we maximize that individual retirement account though? First and foremost, naturally contribute as much as you can. Make sure you're diversified. So you're not just in the US. US only makes up around 60, 65% on a given day, 63% of the overall global stock market. You want to be invested in not just in tech, you want to be kind of invested broadly diversified. There are lots of ETFs, mutual funds that have a basket of funds. So you're not just invested in a particular company. Again, rebalance annually, take a look at how you're invested, make sure you're still on track. Because if certain stocks do really, really, really well and others don't, that ends up over time, that ends up skewing how you're actually invested. That's what we saw with the Magnificent Seven last year and all the tech stocks that were just booming and going gangbusters. They're making up more and more of the actual index, like the S&P 500 index. So over time, you need to rebalance that so it's not overly allocated to a certain sector. Again, consider a Roth IRA for new contributions, my favorite tool, and then convert existing IRAs to 401ks and 403bs into your IRA if it's appropriate. Again, for converting existing accounts, if you're converting something into a Roth IRA, for example, you might owe taxes on the growth at that time. And then you could actually re-trigger the 5-year waiting period or period of if you just open up a Roth account. So just something to consider, especially if you're really close to retirement. All right, I'm going to speed up a little bit because I have quite a few more slides to get through. And again, I want to get as much in as possible. So when in or near retirement, review your allocation annually. Look at the big picture, right? We talked about tax deferred, tax-free, and taxable accounts. If it's appropriate and you want to shift to something that's more conservative over time, consider that. And then move money into income-producing investments. Most importantly, you need to remember that you still need your accounts to be in some sort of growth-oriented stocks or have some potential market exposure. You can't just be in bonds when you enter retirement. They're not going to produce enough for you for that long of your lifespan. So retirement planning process, essential first, right? You want to cover those essential spendings. Do I have enough to retire? Can I retire? Do I have my essential needs covered, that what I have to survive on a monthly and annual basis? Protection goes into when can you retire, right? That can be disability insurance, but also how am I thinking about this? Do I have enough for when I actually want to retire? What do I want my lifestyle to look like? And then how and to whom would I pass on anything that is left over? So essential, protection, lifestyle, and then legacy. So sources of retirement income also. It's not just Social Security and pensions, right? Although that's certainly a good chunk and the majority of it for everybody. And a lot of people end up taking withdrawals from their retirement plans. They receive interest, dividends, or investment income. Some people still choose to work part-time. Some people start to use, obviously, savings and that investment principal, the account balances they've built up over time. They'll start to pull from that, as well as income from rental real estate if they do have that rental real estate. So maintaining an emergency fund. This is crucial. If you were to tell me today, I have all of these great plans and all of these great things, I have all of these accounts, and I ask you, do you have an emergency fund? And you say no. I said, right, stop right where you are. The first thing we have to do is set up an emergency fund. 2020 will be my forever example for the next decade or two of why it's important to have an emergency fund. In case of the unexpected, we have to have something we can fall back on so that we're not pulling money from our 401ks or IRAs and having penalties. You ideally want to have enough to cover expenses for at least 1 year, especially if you're getting close to retirement. Even if you're not there yet, you don't have anything, and trust me, we've all been there. Start trying to build up enough for 1 month to 2 months to 3 months. So you have that ready to go. And if you're closer to retirement or in retirement, make sure some want to consider having 2 to 3 years worth of expenses in an emergency fund. That doesn't mean it's just sitting in cash. It could be in cash equivalent investments, short-term bonds, things like that, money market funds. So it's not just sitting in cash, losing value because of inflation. I'm kind of going to skip over this one. There are some various income strategies in retirement. Systematic is kind of, do I want to take a certain percentage each year based on what my account value is? So I want to have a bucket approach for how I want to allocate my funds, or is there just a set baseline dollar amount I want to use that I need or want to take out each year? But for you to create a retirement income strategy, how do you make your money last as long as possible? Again, know those contribution limits or withdrawal rules for what you're invested in, whether it's a 401k plan or your own, retirement plan. You can actually take the money, instead of reinvesting dividends and interest, it's usually something you select when you're first creating an account. You can actually choose to receive that income. So when bonds or stocks are paying out interest and dividends, rather than that going back in to be automatically reinvested for you, you can actually keep that and it goes into like a cash account in your existing account. Again, you have to take your required withdrawals, RMDs, from your employer plans as well as IRAs once you reach a certain age. In a perfect world, and again, I realize this is not a perfect world, we want to stay between 3 to 4% of that recommended annual withdrawal rate. So if I have $100,000 in the account, I would really like to stay between taking out $3,000 to $4,000 a year. That is certainly easier said than done, and I'm very familiar with that. But that's kind of the ideal goal. If you can stay a little bit below 4%, your account should last you at least 30 years in retirement, historically, given past data. And then you can also increase that annually by the rate of inflation, and then start to pull money from the actual principal balance, the balance of your actual accounts, to meet your income needs. So a couple quick risks I'm going to go through relatively quickly here. Risk, first one, of course, the number one is spending too much too quickly in retirement. You really want to know how much. Withdrawing too much too fast is the fastest way to deplete the accounts. Historically, stocks have earned 7-8% over time. But again, that does not mean each year it's going to be a clean, steady line, 7-8%. That's not how it works. That's why spending around 4% of your portfolio annually may be appropriate. Again, the lower the better. If you're older, or if you are willing and able, keywords, willing and able to cut back on spending in bad times, 5 to 6% can work, but really be careful there. So for example, if you're 65, you have $200,000 in a retirement account, you're receiving $25,000 in Social Security each year. Can you live on a 4% withdrawal rate? So 4% times 200,000 is $8,000 a year, plus your Social Security amount. I'm sorry, I have a typo in here. 70,000 is actually $25,532. So if you have a $200,000 account, can you survive off of $25,000 and change in a given year? Do you have other income sources to cover? So market volatility, negative returns, particularly when you're near retirement, can add a lot of risk to your accounts not lasting as long as they need to. The investments, as we've seen in the markets the last few years, they're going to zig, they're going to zag, they're going to do their own thing. We cannot control that. But even though that 8% return is historically, that's how it's worked or in the past, that does not mean it's going to be consistent each year. So market volatility, especially if you retire into a bear market, those first few years when you're really close to retiring or just retired, do you have other less risky assets or cash reserves so you can keep your stocks invested so they can recover? You want to think about that too. And are you and would you be willing and able to cut spending in certain areas in order to make sure you can let those accounts get back up? So some studies do suggest, building up bonds and cash as you approach retirement. And then once you get there, starting to increase your stock allocation as you age can be the best approach, because you have the chunk of that you really, really need. And as you're getting into retirement, you're starting to use those funds, you're not as reliant on what it's going to grow to. So you can actually start to invest that a little bit more aggressively. And then again, if you have a pension, you're lucky enough to have a pension, that often covers a high percentage of your essential needs. So that's fantastic. So if you need to play catch up, what can you do? Work a bit longer, save a bit harder, invest wisely, stay healthy. Those are the kind of the key things. Health, walking, staying healthy, being engaged with friends and community can really help control healthcare costs and medical outcomes. It's been proven. It's so important for whether it's yourself or for a loved one to stay engaged in their community and take care of themselves. It pays huge dividends, not just socially, psychologically, but financially as well. Consider part-time work. How you're going to keep, how you're going to use your time. Again, we talked about Social Security. When you take it can make a huge difference. If you can afford to delay, please delay. Know that spending. Consider the age you retire. Again, make sure you have a emergency fund, whether that's in cash, a combination of CD, short-term government bonds, money market funds, etc. So the work option, we know if you can continue to work or you're just a part-time work or something else that's interesting, that's great. If you can, any dollar that you're earning in retirement, it's going to offset your expenses is a good thing. Something that's going to keep you busy too. That is fantastic. But other things to consider, and I would be remiss if I did not mention this, in terms of health, you want to think about, again, health, long-term care insurance, your long-term healthcare options, family considerations, your living preferences, advanced healthcare directives. If you have specific preferences on how you'd want to be treated if a health event occurred, you want to make sure that's taken care of. And in estate planning and trusts, make sure you have a power of attorney for healthcare decisions, someone you trust to make those decisions on your behalf. Power of attorney for financial decisions, who can actually step into your shoes to make financial decisions for you, pay the bills for you, potentially sell a house for you. Living wills and making sure you've considered inheritance taxes. So we're going to quickly recap in the last few minutes before we get to questions, some of the best practices to set yourself up for success. First and foremost, number one, as I mentioned, emergency fund, 3 to 6 months of basic living expenses in some sort of FDIC insured account to start. Aim for 1 year, try to grow that to more. Make sure it's invested in something, though, that has a little bit of appreciation, so it's being offset. It's not being eaten up by inflation. Build a buffer fund well before you retire. So that's, again, 1 or 2 years of target spending in safer, it's invested. It's safer bonds, cash, things that don't move quite as much. They don't have as much duration. They're not as volatile. Maximize those 401k, Roth 401k, 403b, 457, et cetera. Maximize your contributions. The more you can set aside now, the younger you are, the higher percentage you can do. Even if you're increasing it 1% a year, makes a huge difference in what that account looks like 20, 30 years from now. You're not going to notice the dividends until you're way further along. But once you do, the numbers are substantially different. Even if you can do that today, increase by 1%. And then next year, increase again by 1%. You won't notice a difference in your paycheck as much, but it will make a huge difference down the line for yourself. Pay yourself first for your future. Add additional retirement accounts. If you have additional funds left over, then consider a traditional IRA, Roth IRA, spousal IRA, SEPs, HSA accounts, etc. Once you've kind of been maxing out some of the match from your 401k and maxing out those other options. And then you'd move to taxable accounts, a bank or brokerage account, if possible, if you have leftover money after adding to the additional retirement accounts. Again, this is all in the mindset of how do we maximize retirement savings. We also know that, of course, sometimes you want to be saving for other goals too, and this would be the order of priority if you want to maximize retirement savings. Monitor your future, keep an eye on those investments, rebalance, diversify, low-cost investment options, maximize the group benefits. Would be like the disability income. If there's a disability insurance option, consider that if that fits into your family picture or your picture. Maintain life insurance if you have it. If you have dependents or you have a need for a death benefit for a loved one, look into that. I personally would tell you term insurance that's just to cover you for a certain number of years is by far the least expensive. It's usually like around 10% of the cost of permanent life insurance. I'd want everyone here to be very careful and read the fine print for some of that. For permanent life insurance, it has a place, but there are some conflicts of interest there for the people that are selling them. So please consider that in detail of whether or not term would be appropriate or you want a permanent policy. And be mindful of how much money that person is making by selling you that policy in advance, because it can be a serious conflict of interest. And aim to build financial resiliency into your pre-retirement and those retirement periods, making sure you have those buffers, you have backup funds, you have other areas that you can offset if markets are difficult or if unexpected expenses come. You want to be thinking through what these potential options are. So you're going into retirement with your eyes wide open. And my chart here got squished. I am so sorry. So this is the same thing in a pie chart of, again, maximize, build emergency fund, build a buffer, maximize your 401k, add to additional retirement accounts, invest in taxable, monitor your future, look at group benefits, maintain life insurance if you have it, build resiliency. Here we go. So this got squished. Thank you everyone for bearing with me here as it got a little wonky in this format. And a reminder here again, in modifying your approach, just going to let everyone take another quick look at this to the kind of some of the things to consider, high level things to consider in depending on which decade you're in of your life. Key thing though is that saving increase, try to get to at least 20%. If you can get to 20% or above, you are going to be in fantastic shape for the future, whether it's for trying to take care of current upcoming needs, 1 year out, 3 to 5 years out, 10 years out, or we're thinking about the longer term outlook for retirement. So a couple other resources, and I apologize, we're already a minute over here, but we'll certainly make time for questions. Some great books, The Little Book of Common Sense Investing by John Bogle, The One-Page Financial Plan or The Behavior Gap by Carl Richards, The Millionaire Next Door, Investment Answer, Principles for Successful Retirement by JP Morgan. It's a PDF. I actually added the QR code to that directly here. It has some good long-term kind of successful investing retirement principles. Local community colleges in the area, SMCC, UCLA Extension, CSUN, CSULA, and a lot of others do offer investing, retirement, or other personal finance classes for adults if you're interested. I've taken some myself at UCLA Extension. They're fantastic. And I have another Build Wealth resource at the very bottom by the Dallas Fed, which is also a fantastic option. It actually has some for kids too, to explain more about these various types of accounts. It actually has workbooks to walk you through thinking about your saving, budgeting, all of the rest of it. In addition, for more information or for getting assistance, if you wanted to ever speak with a financial planner, a certified financial planner like myself, plannersearch.org is an area you can go. It's a database of certified financial planners. You can filter for fee only, fee-based, or whatnot, and then you can actually look at specialties of the planners. You can find them who offer a free consultation. You can see how their fee structure is and all of those various options. Thank you so much for your time. We'll get through as many questions as possible. I want to make sure we do that if everyone can stay with us here. And then I know that we do have, and Caroline might mention this also, our pro bono sessions with my volunteers this weekend at Downtown Central Library, and then next Saturday at the Encino branch, as well as the following Saturday at the Palms Rancho Park branch. We will be having a 1 hour workshop at those branch locations, and then also diving into a 3 hour. So we'll do 30-minute sessions with anyone who wants to meet with a certified financial planner like myself to answer any questions you have. You can bring in your paperwork, you can bring whatever you want. We do this twice a year for the community because we think it's so valuable to be able to speak with a planner. Just anything is kept confidential as well. Okay, so Caroline, back to you. Sorry, it was a lot.
Thank you. No, thank you, Jamie, for a great presentation. We have time just for, I know we're over, 2 questions, and then I will talk about the events. And I think you may have answered the first one a little bit, but so Popbox wanted to know if do you work with people with disabilities, financial management services, any tips? Do you have any person? Would this be like the financial planner search if they're looking for?
I'll be honest, I'm not familiar with GT Independence as a financial management service. There certainly are a lot of people, and there certainly are planners and other individuals who specialize in adults with disabilities. I don't know if you have any information, Caroline, on what resources are available through the library in the situation, but there certainly are some people that do have that specialty and really, really understand the options and other available types of strategies that you can use when you do have someone working with someone with an adult with a disability. But anytime you see anyone that has disability, and this might not be the situation that you're asking about, Popbox, but special needs trusts are so crucial, and they're so flexible, and they're really important to be able to use that. And they're available everywhere, frankly. So with a qualified estate attorney or even online. But I'm so sorry, I'm just not familiar with that company and how they actually work. So I can't really say if they would be a good, if I have a person or a tip for working with them. But I'm sure we can follow up. If you wanted to send in or reach out to the team, we can definitely follow up and see if I can use some additional resources, and I can take a look myself and do some research on them.
Okay, thank you, Jamie. And we have another question. What about those that don't have an employer? Like if you're self-employed, what factors when you're selecting a retirement account or an institution?
Yeah, it's a great question. Thank you for the question. Yeah, if you don't have an employer, whether you're set up as an independent contractor or you have some sort of business entity yourself, if you have an entity, an LLC, you're a sole proprietor, you have something like that, you can actually, that's where that SEP, that simple employee pension plan, the SEP or the KEO plan, or what's also called a solo 401k. You can set those up yourself if you have a business entity, and you can make contributions as the employer and also as the employee on your behalf. If you don't have an employer, and you're just working, or you're not working, but you do have some income, that's where anyone can still create the IRAs and individual retirement accounts. And as long as you have some sort of earned income, and the IRS definition of earned income, you'll be able to set that account for yourself and actually put in up to the max, which is $7,000 a year, into those accounts. Unless you're over a certain age, you can actually do catch-up contributions. In terms of factors to consider in selecting a retirement account, you want to think about what's available to you. So if you do have the employer ones, those are easy. They don't cost anything for you to at least create them. There is an ongoing kind of small, usually management fee on some level. But IRAs, that should be free through the custodian and through the bank. In terms of institution, I would look for ones that have been around for a long time, because we're not looking at credit and what rates you're going to be getting. You want to think about something that's been around for forever. So a lot of the big ones you hear about on the news, take a look at some reviews if you want to, but those are pretty much, you can open up accounts there for free. They don't charge you for having the accounts. They might just charge you a fee when you actually buy or sell investments. And the investment itself might have a little bit of it, usually has a little bit of an ongoing management fee underneath it. That's not going to the institution. So make sure you're doing your research, but you're really using, whether it's some of the online ones that have shown up or the banks that have been around for decades or 100 years. Usually you're in a pretty good shape if it's a well-established firm that's, is going to has security protocols in place. And they have a lot of security protocols that they're required to adhere to. But in terms of retirement account, which one? Your tax situation, contribution limits, how much are you able to set aside? There are income limitations on that. If I didn't fully answer your question, I'd be happy to follow up too if you have any specifics that you wanted to ask for the Zaz family.
Okay, thank you, Jamie. So also I wanted to put our email link, lifelonglearning@lapl.org. We'll put it on there on the screen. If any follow-up questions or anything, please email us. We'll ask Jamie, get the answers and get back to you. So I thank you again, Jamie. Great presentation. I wanted to remind everyone we have 3 more streaming programs coming up this month. The next one's Monday, April 15th, Investing Basics with the SEC. And Financial Literacy Days. We have 3 of them coming up, as Jamie mentioned. The first one is this Saturday, April 13th, Central Library. I will be there, and so will Jamie. 10 a.m. to 1 p.m. So you can, there's like half-hour appointments with certified financial planners, talk about all of your financial questions. And there is an appointment line. That's our website from all of our Financial Literacy Month programming. But the phone number, you can call us 213-228-7140. But I will also, if you go to our LEPL, this Financial Literacy Month webpage, the phone number is on there too. So just go there. Call the number. One of our staff members will call you back. We'll set you up for an appointment. And then the walk-ins are per financial planner available. Thank you so much. So that's the number to call. Make an appointment to this week at Central Library, next week Encino Tarzana branch, and then on Saturday, April 27th at the Palms Rancho Park branch. So all of those are 3-hour events, 10 a.m. to 1 p.m. The branch events also have workshops before it. So there's going to be a retirement workshop again for Encino Tarzana, Financial Planning Basics 101. That's going to be at the Palms Ranch, and then the 101 appointment. So we're excited. You guys are back. It's a full month of programming. So thank you again, Jamie. We'll see you Saturday. And thank you, everyone. Have a great rest of your day. Bye, everyone.
Take care. Thank you.